Welcome back to the fourth video of our series From Zero to LBO, Building a Financial Model of Twitter. After we prepared and built the forecast of our dynamic three-statement model, today we will define and build a simple DCF tool. In this video, we will build this simple discounted cash flow valuation tool to value Twitter based on our earlier developed three-statement model. Our DCF thereby utilizes the flexibility of our API rating model and allows us to input various assumptions regarding WACC terminal value to arrive at an enterprise valuation, taking into consideration several sensitivities. So let's get started where we ended in our last video. First of all, we create a new spreadsheet for our DCF valuation. Starting off with the formatting. We directly plug in the forecast period. As we do not need the historic values for our DCF valuation. In addition, we add the terminal value, which is an important factor, as you will see in a minute. So the first step is that we calculate the free cash flows. To be more specific, we calculate the unlevered cash flows. So what does that mean? If you take a look in the cash flow statement we defined in our last video, the starting point of the operating cash flow is net income. However, as net income also includes interest payments, as you can see in the P&L. The financial structure of Twitter is accordingly represented in the operating cash flow. Hence, when starting with net income, we arrive at the levered cash flow. So this is the cash flow available to the shareholders. To be more precise, to the equity side. So utilizing the levered cash flow in our DCF model would result in the equity value, considering, of course, the corresponding discount rate, meaning cost of equity. However, we will go on to calculate the enterprise value of Twitter. This so-called EV represents the value including equity value and any debt instrument which is used to finance Twitter's business model. We also utilize the weighted average cost of capital, or WACC, to calculate the discounted cash flows and terminal value. Therefore, our starting point is the unlevered cash flow, why we introduce another KPI, the so-called NOPLAT, net operating profit less adjusted taxes. We simply link the respective values from our model and assumption sheet. To arrive at our NOPLAT. So what we did here is simply, as I said, linking EBIT, taking into consideration the tax rate that we assume to be the effective tax rate we defined in our assumption sheet. Next, we incorporate similar line items we are considering in our operating cash flow section in the model sheet. The items we consider either have no cash effect, like depreciation and amortization, or are part of working capital, which we link from our cash flow statement defined in the model sheet. So what we did here is, as I said, we summed up all the operating asset and liabilities, excluding deferred tax assets and liabilities. Although we assume that the asset and liability does not change in the future, so there's a zero change in our planning period. These assets and liabilities include certain tax savings, which have an accounting value. However, thorough analysis of the underlying effects and timings should be conducted when assessing the value of a company. So for the moment, I would consider especially net operating loss carryforwards, which represent roughly 500 million in 2021 in the case of Twitter, in the so-called equity value bridge, which is the derivation of equity value from enterprise value, meaning that you add or deduct relevant assets and liabilities from equity value. The same we would do, or I would do, for these net operating loss carryforwards, as these represent somewhat cash savings in the future. However, as I said, and as always, especially with tax-related issues, you should have a thorough understanding of the taxation and the future implications. The other items of changes in operating assets and liabilities or working capital are more or less straightforward. So we have accounts receivables and prepaid expenses, which grow along with increasing revenues. This represents the fact that our model is revenue driven. However, as you can see, operating lease assets and liabilities also have a net effect, although a minor effect, which is varying across the planning horizon. This minor effect of operating lease assets and liabilities is typically offsetting as the assets and liabilities when initially recognized in the balance sheet, and you assume no direct costs, prepay rents, or allowances or whatsoever, should be offsetting. However, due to the latter items, a net effect like in Twitter's case could arise and hence should be adjusted in the free cash flow statement or free cash flow calculation. The reason is that the relevant cash out in relation to operating leases is already accounted above EBIT in cost of revenue. At this stage, however, we do not adjust due to the rather small effect on the overall valuation. Furthermore, we could also adjust our assumptions to reduce the difference in assets and liabilities by adjusting the relevant figures in the assumption sheet. However, what we should check is the development of expenses if these are in line with revenue development to illustrate the growing nature of Twitter's business. In our case, the key driver is as stated revenue, and hence cost of revenue is planned as percentage of revenue and accordingly growing. So at this stage, and again, as we are currently building a pretty simple model, this is sufficient at this stage. As a side note, the incorporation of any expenses like, for example, the just discussed operating leases in EBIT should always be considered when calculating equity value. As a rule of thumb, any costs that are included in the free cash flow calculation should not be deducted or in case of income added when calculating equity value. In case of capital leases, this is the case as the expenses bear an interest and a depreciation portion. Therefore, the analysis of the affected line item should be performed in detail to identify any effect on valuation. Next, we add our investing cash flow, as these represent capital expenditures. After that, we sum up the relevant figures to arrive at our free cash flow. Let's copy this across to have our unlevered free cash flows for the planning period. Next, we calculate terminal value. So EBIT will be calculated assuming a growth rate, which we will define in a moment. From that, we deduct just the taxes to arrive at our NOPLAT. Depreciation is constant in the planning period. Change in working capital not existent, and investing cash flow equals the change equals depreciation and amortization. Although there are arguments and discussions if there should be more than just only replacement capital expenditures, in my view, terminal value should reflect a steady state based on a constant asset basis, allowing a constant but low growth rate. This is also the fact for, as I mentioned, working capital, which should be optimized in a sense that no change at all affects free cash flow. So after having calculated our free cash flows, we now build or define WACC and define further assumptions for our terminal value calculation. As stated, we use WACC as we consider an unlevered free cash flow or free cash flow to the firm. In another way, WACC represents a hurdle rate when assessing investments. So if we think about objective which we pursue, we try to evaluate different types of investments or capital allocations and find a somewhat comparable approach to compare such investments. In that WACC could be derived as either a market-related approach by using cost of debt and cost of equity derived from the CAPM, or with a predefined hurdle rate based on, for example, returns of capital employed or targeted rate. I do not want to elaborate too much on this topic, but especially in turbulent market conditions with very low interest rates, for example, a thorough analysis on the underlying parameters and implications on your purpose should be considered, as WACC has obviously a huge impact on DCF valuations. Therefore, make sure that the textbook calculations everybody is teaching do make sense when assessing investment projects, M&A transactions, or other capital allocations. But for the moment, we stick to the textbook definitions and define the relevant parameters. In that, we define the transaction date, the growth rate, and EBITDA multiple, and of course the key ingredients of our WACC calculation. So for the moment, we plug in some dummy numbers. And of course, we have to adjust the format. You just have to check out the correct font color. And just the format of our multiple. So sorry on that. I'm usually working with a macro for formatting that I don't have to dig into the menus. So here we go. So next we look into the ingredients for these two costs and define the relevant items. First of all, starting off with leverage. Meaning the weighting of debt and equity. In that, we look up the most recent market cap and take that in relation to overall debt. However, in case of private companies, and apparently Twitter is now a private company, another way would be to look at the market average of comparable companies. In our case, we just look up the respective data collected by Professor Damodaran. So we use the respective data collected by Professor Damodaran. We use risk-free rate, risk premium at a later step, and we look up the respective leverage. So Twitter is in the software entertainment industry. There we have an equity portion of 98%, which roughly also represents what Twitter had before going private. So this is a rather good estimate. And in addition, we can also look into the beta factor calculated by Professor Damodaran, which is 1.2. So next, on corporate debt, the tax rate, risk-free rate, risk premium, and unlevered beta as well as levered beta. So the difference between those two I will explain in a minute. As I said earlier, you should always challenge the data you are using, especially in times when markets, or to be more precise, interest rates are changing rapidly and significantly. As for example, in our case, the data collected by Professor Damodaran was last updated in January 2022. In the meantime, there has been a lot of action in the capital markets. So therefore, always check what is currently happening on a macroeconomic level. In this respect, the definition of an overall hurdle rate as discount factor could be utilized, or even a changing WACC in the planning horizon. However, as always, this has pros and cons, and in our case, is difficult to handle. Therefore, we simply stick to the textbook definition for the moment. So based on that, we plug in the relevant data. As tax rate, we link to the effective tax rate we defined in our assumption sheet. Risk-free rate, risk premium. And as I said, these are more or less dummy numbers for the moment, as we primarily focus on the methodology and building the respective DCF valuation tool. Regarding beta, so the factor we collected from Mr. Professor Damodaran is already the levered factor, but in our case, I will plug in the formula to arrive at a levered beta that you have the respective tool in place. So what we are doing is we are considering our leverage and the associated tax rate to consider the tax shield, which I will explain in a moment. So finally, we are able to calculate the weighted average cost of capital. Before that, we calculate cost of debt by multiplying the respective interest on corporate debt and multiply this by 1 minus the effective tax rate. Just adjusting format. So you may ask why include the tax rate the same as we did here, the levered beta. The incorporation of the tax rate stems from the fact that interest expenses are tax deductible and hence represent a tax shield in reducing taxable income. And therefore, we include the calculation in the cost of debt. Next, we calculate cost of equity using the CAPM formula by multiplying the risk premium and the levered beta to arrive at the cost of equity. So as you can see, the CAPM is a very handy formula and a simple approach calculating equity returns. The utilized beta or the beta factor thereby represents the systemic risk or market risk relating to Twitter. The formula should, as everything, treated, or the formula represents a given fact. However, the underlying hypothesis is rather theoretical and could result in a distorted view of the underlying company, in our case, Twitter. Therefore, always challenge calculations and allege given facts. Sometimes your gut feeling might be the better option than a textbook formula. There are a lot of studies on that topic or even on that religion. So as always, read, and form your opinion on these kind of topics. If you like, we can do a separate video on WACC, CAPN, CAPM, or the introduction of hurdle rates. Just leave a comment. So finally, we are now able to calculate our WACC considering the capital structure of Twitter. So after we calculated WACC, we can now proceed to calculate the present values of our unlevered cash flows. For that, we calculate the free cash flow after the transaction date, meaning the pro rata financial cash flow, free cash flow, sorry, which we simply link from above to account for the respective transaction date. We simply plug in the dates of our cash flows to calculate the respective portion. We want to consider when calculating the free cash flow of the respective year. So the other cash flows simply to the above figure. Next, we define the discount period in years, and as you can see in a minute, we are defining the discount period as a mid-year discount period. So this so-called mid-year convention has a somewhat flattening or smoothing effect on the cash flows. What does that mean? As Twitter or any other company generates cash flow throughout the year and end of year discounting would assume that all cash flows are generated on the last day of the year. For example, if you would assume that 99% of cash flows are generated on January 1st and only 1% on December 31st, end of year discounting would mean that you discount 99% of cash flows by almost 1 year too much. Therefore, through mid-year discounting, we somewhat build an average or smoothing effect to compensate this over discounting. If you have, of course, a highly cyclical business, which is maybe very dependent on Christmas or other specific dates throughout the year or in the year, you could, of course, adjust your discounting period as well. So finally, we combine the discount period with our WACC. to arrive at our discount factor. Which we then use to calculate the present value of our free cash flows. So the last step to calculate our enterprise value is now the calculation of the terminal value. So we introduce two approaches, methodologies to arrive at the respective present value of terminal value. First, we use an EBITDA multiple. So what we link is EBITDA 2027, which we calculated in our model. And we use the multiple we defined here. To arrive at our terminal value as of 31st December 2027, which is just simply the product of these two items. So what we need next is discount period and the discount factor, as we did in the free cash flow calculation. However, what you use here is the discount factor as shown in the last free cash flow of the planning period, which is 4.5, hence meaning the mid-year of 2027. But as we calculated the terminal value as of December, we have to add another half year and then as well calculate the underlying discount factor to arrive at the present value of terminal value. So to arrive at the enterprise value, we simply add up the present values of our cash flow plus the present value of terminal value to arrive at an enterprise value of roughly $60 billion. We also calculate an implied EBITDA multiple utilizing the 2022 EBITDA, which in our case is roughly 1 billion, resulting in a multiple of above 60 times EBITDA. So just for the record, don't put too much thoughts in the numbers we are calculating in this video, as this is, as I said, a focus on the methodology technique to build a DCF valuation. In a later video, we will further analyze the inputs. So the second way, as I said, is the go-on growth rate, which is considering the above free cash flow after the planning period, which we have to calculate, as I said before. We simply grow EBIT in the future to arrive at the free cash flow for the terminal value period. So next, we define growth rate, which we link to our assumptions to arrive at the terminal value as of which is simply the go-on growth rate formula dividing the free cash flow after planning period by WACC minus growth rate, thereby arriving at the terminal value as of June 2027. So the model or this go-on growth rate might seem familiar to you, as the model is also applied in dividend discount models when valuing stocks. In this respect, there is already a discounting period involved, why we stick to the discount period calculated in the last planning year, which is then utilized again to calculate our discount factor. So next, as with the EBITDA multiple, we calculate the present value of our terminal value and again. Add the sum of the present values of our free cash flows to arrive at our enterprise value, which is also used to calculate an implied EBITDA multiple. So as you can see from the calculation here, the terminal values are pretty significant when calculating enterprise value. So what does that mean? Almost all the value derives from the terminal value. Therefore, you should always check the terminal value calculation and the assumptions leading to the terminal value or the present value of the terminal value to see what implications any of these figures or planning assumptions could have on enterprise value. So the two approaches we defined have, as again, pros and cons. Therefore, be careful when defining your approach, as terminal value has plays a dominant part in the overall enterprise. To further illustrate this effect, we introduce sensitivities to illustrate how WACC or how EV is changing when certain inputs like WACC, growth rate, or EBITDA multiples are changed. So for this, we build some data tables. First, we start off with our EBITDA multiple, and we link the value we would like to change in the upper corner of our data table. What that means, I will show you in a minute. So here we plug in the multiple we would like to change in our sensitivity. We define some absolute changes which we apply to the EBITDA multiple, and we plug in the WACC hard-coded. This is needed for the data table function. What I'm doing here. Sorry. So these figures I'm just plugging in are arbitrary, so please feel free to adjust your analysis. This is just to illustrate how such a data table could look like. Just some more editing. before we are finally able to calculate the data table. So row input is the multiple we would like to change. And column is WACC. Finally have our sensitivities. So highlight the value we calculated above. And as you see, there could be just some big impacts on WACC if you increase WACC with the remaining EBITDA multiple and the price value is reduced. If you decrease WACC and the price value is increased. Same applies, of course, for EBITDA multiple. So what we do next is to do the same analysis for our Gordon growth rate. There we link to the growth rate, plug in the 1% here. So as you can see, the Excel is calculating as soon as I enter some data. So with huge data tables, I would recommend to change calculation to manually, as you can run into significant issues with this kind of background calculation. So we add formatting. And finally, we calculate the data table for the growth rate. Again, input the growth rate and the column input is WACC. And as you can see, The same as for the EBITDA multiple applies for the growth rate. So growth rate plays an important role in defining terminal value and hence enterprise value. The same applies for WACC. Therefore, the respective valuation results are typically shown in a somewhat range when you look at valuation presentations in the professional world. And this illustrates the implications of changes in underlying parameters. We will further explore sensitivities in a later video when we build a simple Monte Carlo simulation on top of our DCF valuation. But for the moment, this concludes today's video. I hope you enjoyed the process of building a simple DCF tool and you gained some insights in how to and what the different figures, parameters imply for the overall valuation. So if you liked the video, please subscribe to our channel and leave a thumbs up. In addition, please turn on notifications if you would like to be notified when we upload further videos. In addition, please drop us an email if you're interested in the final Excel model and the step-by-step documentation outlining a detailed guide on how to build this operating model with the DCF, LBO, and sales sensitivity. Our next video will be the LBO model, followed by the introduction of revenue cases to finalize the overall financial model of Twitter. After that, we will start the analysis, taking a closer look at Elon Musk's takeover and see how the planned restructuring measures on financing, etc., could impact Twitter's financial development. So, thank you very much. Looking forward speaking to you in our next video. Bye bye.